Now we turn to a top-performing bond fund manager. Tom Goggins is the co-manager of the John Hancock Strategic Income Fund, which Bloomberg ranks among the top-performing global bond funds for the past 1, 3, and 5 years. The $2.8 billion fund invests in sovereign debt, high yield, and convertibles, but holds no U.S. treasuries or government bonds from Ireland, Greece, Portugal, or Spain. And this is all, Tom, thanks first of all for joining us. This is all by choice, obviously. You could hold U.S. treasuries if you wanted. That's not the design of your fund. Why do you stay away?
Well, we think that the U.S. Fed is one of the only central banks globally that's not raising rates. We think the economy is doing just fine, and we got some hints of inflationary expectations. So we think that the U.S. 10-year, for instance, should revert back to where it was last April, around 4%. So that's why we're actually short the 10-year bond contract in the John Hancock Strategic Income Fund.
Does that happen with the end of QE2? I mean, do you think when the Fed gets out, at least a little bit out, we start to see yields rise?
Yeah, I think you'll see a gradual rise in interest rates after QE2, but I think that's also coupled with a stronger economic backdrop here in the States, and also concern about inflationary expectations, despite what Bernanke said in his press conference earlier this week.
What did you think of that press conference, by the way? Did you get anything out of it? Did you feel that some uncertainty was taken off the table?
Well, I think what he said was that there wasn't going to be any movement on the short end of the yield curve until 2012. And so what that means in our way of thinking is that you're going to get a very steep yield curve. And that's why we've been out of U.S. Treasuries since middle of last year, long before a lot of other people exited the trade.
You're not involved in the sovereign debt of the countries everyone's so concerned about over in Europe either. Is there a point at which you would buy that debt, or do you think restructuring is inevitable in Greece, in Ireland, and you need to stay out until then?
Yeah, Matt, as we say, we've been pig-free in our strategy since '07. So we haven't had any inkling to go into any of the pig countries right now. I think it's really for two reasons. Number one, you have one monetary policy, but yet 25 fiscal policies in the EU. And also there's a backdrop of a banking crisis where you have many of the mutual banks and Landesbanks in Germany holding debt in many of these pig countries. And so they need to really raise some capital. So until we see that take place, we see other opportunities elsewhere in the world.
How long does it take for this to play out in your view?
I think it's going to take a while, because so far the European community has really been kicking the can down the road and has been taking a go slow approach to resolving the issues in Greece and Portugal and Ireland. So
let's look at where else you like to invest in the world regionally here. Sure. You like emerging market debt. Where and why? Yeah, we really like emerging market Asia particularly. And the interesting thing there is while rates have moved up and you've seen a tightening cycle driven by, for instance, China, a lot of the countries in the Pacific Rim have seen their currencies appreciate versus the U.S. dollar. So, for instance, we've made a tremendous amount of money in places like Singapore. Well, the short end of the yield curve has moved up a bit. We've made double-digit returns on the currency exposure that we have in places like Singapore and Korea. And that's one of the aspects that I think we do a little bit differently, is that we treat currencies in our strategy and fund as an asset class. So it's an FX play. So you got FX guys working for you in the fund. Exactly. And I think that's a nice complement to the credit calls we make and the duration calls. What about corporate debt? What do you like as far as the corporate realm is concerned? Yeah, we're still overweight high yield, Matt. We still think that valuations are attractive. Corporations in the U.S. have really pushed, the high yield guys have pushed out the maturities in terms of their high yield debt out to 2017-18, holding more cash on the balance sheet. And then we've also moved up in terms of the percentage of the fund in senior floating rate bank debt, which is more senior in the capital structure, and then we get the optionality of the floating rate because it's tied to LIBOR. So kind of two advantages to going into senior floating rate debt at this point. How much further do you think we have to run in high yield? I mean, you just take a look at that chart that we were just showing here. Right. It's incredible how much it's come back since March. I guess the same could be said of the equity markets, but it's completely normalized, it looks like, and continues to run higher. Yeah, and I think what you're going to see is the
25-year historical average has been about 525 basis points above the U.S. 10-year yield. And so we think you'll get down to a 4 handle on that just because the demand for high yield is outstripping supply. So we think that you're around the 7th inning stretch of high yield.
Does it concern you? You know, we've been talking a lot this week about the possibility of another recession here just because of the spike in oil prices. And out of the last 12 recessions, you saw a spike in oil prices preceding them the last 11, at least 11 of the last 12. Would that concern you? Would that be a worry for you that defaults are going to start picking up and you need to get out?
Certainly, we're monitoring all of our companies and sectors that we're involved in, Matt. But right now, I think the safer bet is to expect the economy to slowly expand like the rest of the world is. And so we would rather put our eggs in the basket of expansion rather than a double dip. And that served us pretty well last year. While a lot of people are concerned about a double dip, we actually increased our exposure to high yield, and that really proved out to be the right call.
I'll squeeze in a quick question here from a viewer. Tom, he asked if you're short the 10s. I know you're not in U.S. government debt, but are you short the 10s here?
Yes, we are. And we think that as the 10-year yields move up, it's a very good way of making money in a bond fund in a rising rate environment. So it's oftentimes people think you can't make money in a rising rate environment in a bond fund, and we think we can.
Tom, thanks so much for joining us. It's been a pleasure. Tom Goggins there from John Hancock.